There are two options when it comes to structuring the drawdown of equity or the use of equity to help purchase a property. The first one is the best option. It's the preferred option. So we'll talk about that one first. In our example, we've got a family home that's worth $1 million. And that family home has a loan of $445,000 secured against it. It's an owner-occupied loan on principal and interest repayments. And we want to purchase a property for $600,000. Now, on a purchase of $600,000, we usually have about 6% in government and legal fees. That includes conveyancing costs, stamp duty, transfers, registrations, and land tax or council rates. So all up, we're looking at a total cost of $636,000. Now, if I tried to secure $636,000 against this home that's only worth $600,000, you can see that we're trying to borrow 106% of the value of that property, or 106% loan to value ratio. And the banks say, thanks, but no thanks. We're not going to do that. So we need to get this loan down to a level where the bank's actually going to be happy with it. So we want to get this loan down to 80%, so we don't have to pay mortgage insurance. And 80% of $600,000 is $480,000. But we still need $156,000 to complete our purchase because we need a total of $636,000. We know we can't secure that $156,000 here, so we take that $156,000 and we borrow it against your existing family home. Now, to keep your accountant happy, to keep the ATO happy, to keep everyone happy, we do these loans separately. We don't want to combine these two loans because this is your owner-occupied loan. That's for personal use. And this is your $156,000 investment loan. So we don't combine them. We never, ever want to combine them because we want to keep them separate so that at the end of the tax year, you can take loan statements for this loan and for this loan to your accountant and get your tax deductions on the interest and the fees that were charged throughout the year. All right, so there's a method to the madness. We want to keep these loans separate. And you notice this big gray line here. That's there on purpose. It shows that we are not cross-securing anything. So this property is only securing this loan. This property is only securing these two loans. The other common question that we get is, David, why are we securing $156,000 against my owner-occupied loan or owner-occupied home? Doesn't that make it an owner-occupied loan? No, it does not. Very good question, very common question. What the ATO is looking at is what was the purpose of this loan? And the purpose of this $156,000 was to help purchase this property. So the ATO says that's fine. You can treat it as an investment loan. So at the end, you can get tax deductions on the interest and the fees that are charged on that loan, as long as we keep them separate.